Look, if you make money trading or investing in cryptocurrencies, then you have to pay a tax on your crypto profits, right? Well, kind of, sort of, not always. In fact, I've found 5 ways that you can give your crypto gains a huge boost by keeping more of it in your pocket. And in some cases, all of what you've made legally. Okay. So stick around as we go through 5 ways to reduce or even eliminate your cryptocurrency taxes. Number one, and this may be the most obvious one, but relocate to a crypto friendly country, something I've even been considering. The first option sounds pretty drastic, but it's also kind of the most straightforward. If you don't want to pay crypto taxes, move to a country that doesn't have crypto taxes, right? Now, you might wonder whether we're talking about seriously sketchy locations here, but actually, no. Some of these locations are very desirable, sometimes the most desirable places to live in the world with very high standards of living, and a lot of people recommend going to them. Besides the financial advantages, lifestyle, and all the rest of the stuff can be great there. One place that gets a lot of attention, of course, is Dubai in the United Arab Emirates. You could go to Abu Dhabi too, I guess. But anyway, take a look at projected millionaire migration for 2024. And the UAE is right at the top of the list. And it looks like a lot of rich people are heading there from the UK, from China, probably from France pretty soon with their 90% proposed tax. But anyway, besides the reputation for luxury, what you also need to know about Dubai is that if you are a resident of Dubai, there is no capital gains tax on your cryptocurrencies, also no personal income tax. And when it comes to crypto, there are no reporting obligations. Yeah, that's awesome. Dubai is also a good location for crypto in general. It's established itself as a major regulatory hub for crypto, and they've got a framework called VERA, that's Virtual Assets Regulatory Authority. They established that back in 2022, putting itself on the map as a place where crypto startups can do business, where crypto companies can thrive. Now, if you prefer a more laid back island lifestyle, the big Dubai scene is not your ticket, okay? What about the Cayman Islands, where again, you're going to be free from capital gains tax and from income tax, and with no crypto reporting requirements at all. In fact, there are several other countries here to consider, including Bermuda. Again, more of that island lifestyle, right? You have big, thriving Asian cities, if that's more of your go-to. Hong Kong, Singapore, they currently don't impose any capital gains tax on crypto profits for individuals. There's even other countries that have very crypto-specific laws, like Portugal, that have low or no tax. Crypto-related laws, of course, can change, so you need to monitor the latest updates. And of course, you need to look into the visa processes, the costs of living, all that kind of stuff, right? There's no point moving if all the money that you save on your taxes then gets taken up paying the rent. Okay, so you need to make sure it's worth your while to do this. And before we get on to point number 2, just note, I'm not an official tax person, okay? I'm not giving you official tax advice. I'm just a dude on the internet talking about stuff. So please talk to a real tax person before making any big tax decisions in your life, okay? Okay, so number 2, use a retirement account. Now, this might not be as exciting as moving to Dubai, okay? But it's way less of an upheaval of your life, as it simply means investing in crypto through a retirement account, which can be a tax efficient way to do it. And with Bitcoin ETFs here, ETH ETFs coming, applications even filed for Solana ETFs now, it's becoming easier than ever before to invest in cryptocurrencies through an IRA. Also, with some self-directed IRAs, you can even include all kinds of alternative investments that wouldn't normally be allowed in a more serious IRA, including, of course, wider ranges of cryptocurrencies. Now, an option for doing this is I Trust Capital, who is a channel sponsor, although they're not sponsoring this video, but I feel like a conversation on IRAs would be pretty much incomplete without mentioning them. So go and check them out if you're interested in that kind of stuff. Anyway, IRAs don't necessarily mean you're paying zero tax overall, but with a Roth IRA, for example, you pay tax when you contribute in, so when you buy the coins. But you don't pay any taxes when you withdraw later, meaning that gains made in the meantime will be tax-free. However, you can't freely withdraw earnings without incurring a penalty in this particular one. That's at least until you're 59 and a half years old, and the account must be at least 5 years old at the time. Now, with a traditional IRA, not a Roth IRA, the system is the opposite way around. So you get a tax deduction when you pay in, but you pay tax on your withdrawals later after any gains have been made, of course. Although it's worth keeping in mind that's actually charged as income tax. So depending on your tax rate, could be okay. Anyway, so if you're a very, very long term hodler anticipating price growth, a Roth IRA might make more sense, especially now that you can make use of ETFs. Meaning, of course, you can keep everything entirely on traditional finance rails. Or if you want the altcoin exposure, you got to get yourself some Dogecoin or whatever other alternative assets. That's still possible through a self-directed IRA or a service like iTrust Capital. Okay, so check that out. There's another option though, which is that but look, before we get to the next point, I just have to remind you that every week my team and I are putting together the best newsletter in the cryptocurrency industry. It's called Wealth Mastery, and it is packed with alpha on all kinds of stuff happening in the market. Bitcoin, altcoins, NFTs, DeFi, with charts, technical analysis. You can join our 135,000 plus weekly readers for free using the link in the description or the pinned comment on X. Thank you very much. By the way, our readers love it. I'm sure you will too. So check it out. Okay, now on to another way to keep your crypto gains, which is to not sell, borrow instead. So if you never sell, you never pay tax, right? But then how do you unlock your gains? Well, the answer is to use crypto lending platforms, meaning that you can use your cryptocurrency holdings as collateral to take out a loan. This means you're not disposing any of your assets, and that means there are no taxable events. For example, a centralized exchange where you can do this is called Ledn, Ledn. It lets you take fiat loans backed by Bitcoin or Ethereum at a 50% loan to value ratio, and with interest rates currently starting at around 12.4%, which is pretty high, but still. Keep in mind, centralized services carry significant risks, okay? You can lose all your money, all right? There are also on-chain options such as Aave, which offers loans to be collateralized by a range of different coins at varying APRs. So there's that. There's also stuff like Thorchain, which facilitates Bitcoin or Ethereum-backed loans and has no interest rates. But DeFi borrowing, still a gray area regarding tax. Some places want to tax on it. Some places don't want to tax on it. Sometimes depends if you get proxy tokens or whatever. Protocols seem to be offering loans, but there's really no IRS guidance right now on this particular subject. So we can't say for certain where it's going to fall, and your jurisdiction might be different, okay? But at least smart contracts are usually safer than centralized services, assuming they don't get hacked, which happens sometimes. And also, now that we have Bitcoin ETFs, you might be able to take a cash loan versus your ETF, which is, to be honest, the safest route to go of all three here, okay? It really, really is, especially when you have Ethereum ETFs, Solana ETFs, you have a lot more range of assets you can take loans versus. And I know I said it once, but it's so important. I have to repeat this. Beware of the risks. You're transferring crypto custody away from your own wallet. And as we saw in 2022, we saw a domino rally of crypto collapses that resulted in users across multiple lending platforms getting screwed, collectively losing billions of dollars. Plus, protocol exploits are a constant hazard in DeFi. So while we can hope that, of course, crypto space is gradually becoming more and more secure, there's a lot of lessons learned here. There's a lot of risks out there. And of course, it's massively volatile, so you can get liquidated on your loans too. So keep that in mind. So then perhaps a safer option is to gift your cryptocurrency to family members. Now in the USA, currently may apply in some other jurisdictions. Talk to local tax people. The numbers change from year to year. Okay. Anyway, so when you gift someone assets up to $18,000, that's not taxable at that time, and it doesn't need to be reported. And even over $18,000, it needs to be reported, but still remains non-taxable up to a lifetime gift tax exemption of $13.6 million. So you got a little bit of room there, huh? However, your cost basis, how much you bought the crypto for, is carried over to the recipient. So if person A bought Bitcoin for $30,000, they then gifted to person B after the price went up to $50,000. No one pays any tax yet. But person B now has one BTC at a cost basis of $30,000, the amount that A paid for it, okay? Then let's imagine B holds a little while before selling at 5K. So remember, their inherited cost basis is $30,000. So then I have to pay tax on a $25,000 profit. 20,000 inherited plus 5,000 held. In this way, any eventual capital gains tax is carried over along with the crypto itself when it's gifted. Okay, but the useful factor here is that the person receiving the gift could be in a much lower tax bracket. You follow me? So they'll pay less tax when they actually go to sell that crypto. So that is where the advantage comes in here. This one depends, of course, on your household. But if there are variations between different family members' tax rates, then you could potentially ensure that your assets belong to and are disposed of by the sellers who will end up paying the least tax. Pretty interesting, right? And finally, you can also donate your crypto to charity and claim deductions. Now, for this, first, you're going to need to find a nonprofit that you want to support and that most importantly accepts cryptocurrencies. There's a long list of candidates at a site called The Giving Block. But in the USA, and again, this might be different depending on what country you're in, you must choose a 501c3 charity. With a crypto donation, any gains on the crypto's value since it was bought are not taxed. So it's a much better way to donate doing this than by selling your coins for cash, which would be a taxable event. And in addition, the donation is tax deductible. Okay, so you can deduct that on your return as a charitable deduction. You should keep records, of course, of the donation when you do it. Make sure you're accounting for it properly and get that deduction on the fair market value of the crypto, aka the higher price when you donated it, rather than on the cost basis. Okay, obviously, you need to have held the crypto for at least 12 months here, as is usually the case. But basically, though, crypto donations to charity are tax-free and tax deductible. So it's pretty interesting. Okay, something to keep in mind. Anyway, just a couple of things to remember in general. Tax rules vary obviously between countries, between states, between cities, all that kind of stuff. And I've been focusing today primarily on the USA, but a lot, actually quite a few places have pretty similar systems. The rules and numbers and stuff are going to be different. You need to talk to your local tax person again, right? Also, we definitely don't want to break any laws. We do need to pay our taxes, right? So if you're ever in the slightest doubt, then again, run your plans by a tax advisor. Find out what you can legally do to reduce your tax burden. That all said, I hope this video has at least given you some useful ideas to work with. Now you can ask the right questions to your tax person at the very least, right? Thanks for watching.